Welcome back to Trading Hour on CNBC TV18, still where we were when we started. So the Nifty is still down about 180 points. But to discuss the market fundamentals and the top sectors to bet on, Pankaj Murarka of Renaissance Investment Managers joins us now. Pankaj, thanks a lot for joining us. First I wanted your thoughts on the auto sector, because after a very challenging period in the last 5 years, in which the auto sector earnings had declined almost 7% compounded in the last 5 years. Now we are starting to see the auto's share in the profit pool improve. From a earnings perspective is what I'm talking about. Do you think that the risk reward is favorable for an investor, and is this a structural uptrend now in autos?
Absolutely, I think so, Sonia, because as you rightly said, the auto sector has had multiple headwinds over the last 5 years. And the last one has been this whole chip shortage, because of which last 2 years they've been constrained with supply chain, and as a result of which, while there's been a strong demand, these companies have not been able to fulfill that demand. I think we are at a point where we are seeing very strong demand across all the segments of the auto sector. Probably another short-term headwind they had in the start of the year was this rising commodity prices, but now that has also softened quite a bit. So I think the sector is clearly in a sweet spot where we are in an environment where demand remains strong. Supply chain issues, including the chips, have got resolved significantly. And commodity prices are moderate, so which effectively means you get strong revenue growth. And more importantly, we got very strong recovery in margins for auto companies. So I think over the next 2 years, we believe that the entire sector is a very sweet spot for investors to bet onto. From a slightly more medium term to longer term, I think passenger vehicles in India remains a structural story, whereas all of us know CVs are very closely linked to the domestic economy. So the element of cyclicality cannot be eliminated, but I think next 2.5 years, we have a very strong CV cycle on our hand as well.
Pankaj, you've been betting on this China Plus One, the PLI theme. We know there have been a few successes like Dixon Manufacturing. It's done exceedingly well in contract manufacturing of TVs and now mobile phones. Can you tell us, other than that, what has been the success? What, according to you, has been the feedback on the PLI scheme? Where is it done well and where is it failed?
I think I'm extremely optimistic on this whole renaissance of India's manufacturing, because effectively, actually, what we should have done probably 15-20 years back, and we have missed the bus multiple times. I think we've reached a time where stars are aligned for revival of India's manufacturing, because one, clearly, if you talk to the top 2,000 global companies, it's part of the strategic agenda to de-risk or diversify the manufacturing away from China, because China is so much integrated into global supply chain. And with this renewed lockdowns in China around COVID-0 and stuff like that, it just makes life difficult even more for them, and it creates a greater sense of urgency for them. I think rightfully, Government of India has taken a few right steps. One, including reducing taxes on the new manufacturing to 15%, and plus this production incentive scheme. So effectively, India becomes a place where you have the lowest wage cost now amongst the large economies in the world, lowest direct tax rates, and on top of that, you have incentives which are linked to production from the government. So probably it's the best place if you look around in the world to probably set up a manufacturing base. While these numbers are very small at this point of time, but we have done some numbers on it, probably because the way PLI scheme works, when you set up a new manufacturing, you reach your peak production in the 4th and the 5th year, and which is where the incentive balloons. We think in the 5th year, which is effectively FY27, the direct PLI linked manufacturing and all the associate manufacturing that will happen because of that, or the entire ecosystem, that can effectively contribute incrementally 1% to India's GDP. And we think that's a very massive number on a large economy like India, incremental 1% coming from just new manufacturing initiatives.
Pankaj, good morning and thanks for joining us. This is Pavitra. Another space I want to ask you about is the banking stocks. We've seen a big run up there. We've been talking about the cleanup. We are seeing credit growth now pick up. Do you think even now at these levels they pose an an attractive investment opportunity? And within the banks, then what do you what would you pick?
So yes, Pavitra, we remain positive on the banking sector as a whole, because I think now it's almost after 5 or 6 years, the sector has come to a point where we're seeing one, strong growth. More importantly, we don't see asset quality issues, which was plaguing at least the state-owned banks and some of the other banks. So those are clearly behind. And more importantly, banks tend to experience better margins of profitability in a rising interest rate environment, which is where we are, because there's always a lag in passing on the deposit cost to the customers, and the loan repricing happens much faster. Incremental credit offtake on banks have been very strong. So we continue to like some of the larger private sector banks in India because we think they're a secular growth story, and given the strong growth momentum in the domestic economy, bank is a very big macro play on the domestic growth in India. Apart from that, but I must also say that we find a lot of value in some of the mid and small cap banks which have been beaten down very badly because of somewhat elevated NPAs they had during COVID, but we think they've tied over those. So we see value in some of those mid and small cap banks as well.
Okay, by the way, in a falling market, one space that continues to rally is defense. Just look at the moves there. Bharat Dynamics is up almost about 9% right now, huge volumes. Mazgaon Dock is up about 6% BEL is up almost about 5%. So the gains continue there. I want to ask you about defense, Pankaj, but before that, the Indian corporate profitability has definitely improved. I mean, the corporate profit to GDP ratio is now at a decadal high of 4.3%. A lot of brokerages have raised their nifty EPS estimates for the full year. Would you do the same? If yes, what are your own expectations?
Well, this year is going to be a year of strong growth because I think second half of this year, as we kick into a festive season, consumer demand will be very strong because the trend we are picking up is clearly that after almost 2 years of COVID-driven lockdowns and unlock, this is the real time when consumers are really stepping out and spending. And at the same time, corporate investments continues to remain strong. So I think second half of this year will be strong. But at the same time, we also believe that given the fact that interest rates in India will rise from here on, this can pinch into some consumer demand going into next year. So probably we still think that India can still do a mid-teens kind of earnings growth going into next year. I still think, which is very healthy in the context of where the world is.
All right, we can see a mid-teens kind of earnings growth for India for the next year. Pankaj, we'll leave it at that today. Thank you very much for joining us and taking us through your call on the market. By the way, some of the sectors that Pankaj just mentioned that he likes is the auto space, the banks, and also the capital goods sector. But with that, we're going to get into a short break now. When we come back, we'll discuss more on the markets and some stocks that are moving around. So stay tuned.